I'm so excited for our next guest that we have here. For this session, we have Liz Simi. She's the Chief Investment Officer and co-founder of Honeytree Investment Management, and she's going to give us some intelligent insights into the world of ESG investing. Honeytree, which is based in Toronto, combines ESG and fundamental research to build portfolios and make investment decisions. Liz, along with her team, manages Honeytree's active investment strategies for institutional and private clients. And Honeytree is proud to be one of the very few female-led responsible asset management firms globally. Kudos to you guys. Prior to Honeytree, Liz worked at Bristolgate Capital Partners. Now, before we get started, don't forget that Liz is going to take your live questions at the end of this session. So again, if you're in YouTube, write them out in the chat box. If you're on Facebook and LinkedIn, add your questions in the comments, and we're going to try to get to as many as we can at the end of this conversation. I'm sure you're going to have a ton. So let's get right to it. Now, we have a slide here that explains what ESG is. So we level set a little bit for our viewers. If you haven't heard of it, ESG stands for environmental, social, and governance. And you can see the explanation there. Liz, the popularity of ESG, it's been on the rise though now for several years. It's increased by a third to become a more than $30 trillion market between 2017 and 2019. That's 2 years, that's it. Some are attributing the more recent popularity to the pandemic and the coinciding social unrest. Do you think that's the case, or would you attribute the more recent popularity to something else? What are your thoughts?
I think the recent popularity is driven by the end client. I think whether that's millennials who are self-directed investors or working with advisors or institutions like endowments and foundations that kind of care about what they're investing in have been looking for opportunities for a very long time. And one of my first real ESG experiences, they launched a gender equity ETF in 2018 in Canada. And I was really excited because I thought it's investing in all the companies that care about gender equity, which is a big thing for a woman in the investment industry since there's not that much gender equity. And I remember looking at it, and there was two big banks in the biggest positions. And then there was a tech company, and I was so excited that the tech company in Canada was diverse. But then I went to their website, and they only had one woman on the board, and they only had the head of HR as a woman. And I thought, this isn't investing in gender equity the way I would want to do it. So I think the drive and the change is coming from that end investor who wants to make money and who knows that companies who are committed to the long term, committed to responsible business practices, committed to their employees and their products, those are the ones who are going to outperform. And so when we see a company that is doing stupid stuff in a portfolio or strategy, we think, and the same thing goes with fossil fuel. You see a lot of movement in the endowments, even in the US, to go fossil fuel free because, their stakeholders are profs and students who care, and that's their job. So I think there's a lot of things driving it, but I think the end client and their needs and what they want is the ultimate driver. And, the pandemic has accelerated some stuff. We can see how companies screwed up or did well, especially around their employees over the period. We can see who furloughed everybody versus who paid hazard pay, who took care of their employees' safety as a priority. And so we kind of got to see it firsthand, hand in hand with the racial equity discussion, which existed in other industries, but honestly, we never talked about it much in investing. So that's accelerated the discussion around the shift to equity from just talking about the environmental side of things. So lots of stuff moving very quickly in the space.
Yeah, absolutely. It's a fast moving topic for sure. And, the people usually get what they want. But to your point, we're going to talk about it in a bit, but there's still some murkiness around it. We're trying to get to a better place from a transparency standpoint when it comes from ESG. But before we dig into more questions, let's take a poll. We've been doing this all morning. We've had a lot of success with it. So this question is, you guys know the drill. Go to ally.com/live poll or click on the link in the YouTube chat. The question is, how much you know about ESG investing. A lot. I'm pretty much an expert. A little. I want to learn more. Or none. What the heck are you talking about? So I'm going to give the viewers a minute to respond to that question. And in the meantime, I'm going to dig in deeper with you. Does ESG, this is, I think, on a lot of people's minds, does ESG really make an impact when you're investing in companies or ETFs that focus on ESG? Are you better off doing that or just sending your money directly to the charities that you believe are centered around making a difference?
Philanthropy is great. Everyone should do it, especially in your community. The reason ESG and impact gets confusing is because the term impact has been traditionally used to talk about private investment. So private real estate, private equity, venture capital, those type of things. And so the impact investment world, I don't want to say they've stolen the term, but the idea of impact traditionally is, okay, I'm buying a wind farm or I'm investing in a wind farm. It's all impact because it's all renewable energy. Therefore, I'm making a direct impact, which is true. You know, if you invest in a woman-founded firm, you're making an impact on gender equity. But the idea that really large companies can't make an impact has always confused me. Everybody, every company, every corporation, every person makes a net positive or net negative impact. And the bigger a company is, the larger the scale. And so traditional ESG, it's just part of the confusion, traditional ESG began as traditional socially sustainable, socially responsible investing began as taking bad companies out. Then we came along with ESG and said, okay, we're going to look at environmental and social data and make sure these companies are doing good and maybe they'll outperform. But using ESG data, you can actually look at the company's impact. You can see how many more Black leaders they're hiring, how many more women leaders they're hiring, how they're shifting resources in their supply chain to ensure decent work, make sure there's no slave labor, make sure their environmental stewardship carries all the way down the line of their supply chain and into all the communities they work. So the idea that a large company like Clorox or Bank of America or whoever doesn't make an impact doesn't count their activities on the positive side of changing the world for better, but it also misses their negative impacts, right? And so whether that's underemployment, not offering full-time jobs, hazardous waste, bad leadership, the impact is much bigger than just a product in the traditional sense. So of course your investments make impact. Using ESG is just a way to assess the scale of the impact for these large companies.
So how do you, knowing that's like a lot as well, before I dig in, it looks like a lot of the folks watching right now are not experts. They want to learn a lot more about ESG. Some of them probably haven't even heard of it, which is great. That makes me so happy that we have you here to have this conversation with today, because this is such a new trend and it's an exciting trend, but there's a lot to learn and educate yourself on about it. So getting back to what you were really just talking about, it can be overwhelming. Oh my gosh, there's all this different information that determines what makes an ESG investment an ESG investment. Where do I, as a normal person, trying to invest in these type of companies or ETFs, how do I find that information and know what I'm truly investing in really is focused on some of these environmental, social, governance issues that I care about?
Well, I think you hit it on the head. It's all of the issues you care about. It's, we tend to pigeonhole, here's the environmental stuff, here's the social stuff, here's the governance stuff, but is this company leading with purpose that's aligned with, the economic theory, productivity, human-centered, systems? And so backing up, what we do is we look at the purpose. Are they purpose driven? Are they stakeholder focused? Now, those terms I get are pretty kind of up there, and they're not investment terms. These are governance.
No, they aren't.
terms. But what's important to us and what we use the ESG data for is to assess how committed a company is to long-term responsible growth, which I think is simple enough. You're either a company that's committed to the short term and the quarter and deliveries or whatever, or you're committed to long-term stewardship for all your stakeholders, employees, customers, supply chain, shareholders. And so there's a lot of ways, if that's the way you want to look at it, because there's some people just look at it on, emissions or diversity. If you want to look at it holistically, I think that's a really good way to start. And honestly, if you're investing in individual stocks, individual companies, it's pretty clear when you look at their website and their financial reports who they're focused on. We did an exercise in March, I guess in our March or April letter, and we looked at the language in all the companies we hold, and they all focused on their employees in the first two paragraphs, not their financials, but how they protected their employees, how they focused on them, how they ensured pay, how they ensured safety. And that tells you an organization's committed to their stakeholders, and they don't think shareholders are the most important thing. And companies like that are much more likely to be figuring out their environmental problems and figuring out their equity problems. Whereas all the companies who are like numbers, look how we did, we don't really care about our employees very much. They're just much less likely to be doing, to be worried about their packaging and reducing the amount of packaging on all their shipments because they know it's cheaper and good for the environment. And that's what's always confused me about the ESG and the impact world. Folks think that ESG reduces returns, but how can saving money on shipping, on fuel and packaging and in time, how can that be bad for the bottom line? So I would recommend starting with the big picture instead of any specific details. What type of company do you want to invest in, assuming you're going to individual stocks? And then really just learning about it and then worrying about the ESG data, because you'll see it in their long-term focus. It's really ESG, I believe, is really about assessing, in addition to financials, how long-term focused this company is.
Yeah, I mean, you're driving me right to my next question, but I love the way you just laid that out because it's one of these investing terms that seems super intimidating, at least, when you first hear it. But I think what you just said makes total sense. Go to the company's website, read the website, read the 10K, pull up some of their financial information, or go to the investor relations portion of the website and see how they talk about things. That's really great advice that our viewers definitely can take with them if they're interested in this type of investing. But the next question is, and you said it, let's talk about the risk reward situation here. The knock on ESG investing is really that you sacrifice performance in return for doing good. Is that true?
No, and I think it comes less from people hating the idea of saving the world and more from our traditional beliefs about investing in the professional arena. So among the professionals, whether they're at funds or pensions, there's a lot of traditional theory about investing that doesn't mash well with some things we do in ESG, like fossil fuel free. I think a lot of people in the world don't have a problem with the fossil fuel free portfolio, but a lot of investment professionals do. And it's not because they don't want to get rid of their underperforming energy. It's because they're trained to have specific sector exposures or they're minimum number of positions. You can't get rid of something or it will cause a return issue. I was lucky in Lindsay mentioned Bristolgate earlier. My firm ran a US equity strategy, but we never had any fossil fuel in it, not because we were ESG, just because that didn't grow sustainably enough. And so I didn't grow up with that bias that we needed to own energy in a US equity strategy, which is part of the reason we could do ESG the way we do. But So I think the belief that ESG underperforms is obviously a little bit, caring about this stuff is bad for the bottom line, which is totally ridiculous. But it's also traditional theory kind of intersecting in saying, you can't do all the stuff. You can't, we got to focus on our fundamentals. We got to focus on our financial analysis because that's what matters. And I think most of the listeners here would be more familiar than most of the investment industry with leadership science, which says more diverse teams. When you get a board or a management team or leadership team together, teams with diverse backgrounds outperform. It's because you've got a team of outsiders; they're better able to see blind spots. There's a whole bunch of impacts there, but that's not normal in the investment industry. So they're just kind of trying to wrap their heads around, should we have more women at the table? I shared, I don't know if you saw this tweet, Lindsay, one of the leading ESG firms in the world happens to be Canadian, one of the highest scoring ESG companies in the world. 40% of their staff are women, 4% of their vice presidents are women. So they're selling all this ESG, but they haven't figured out that you need a diverse team to succeed in the long term, and you gotta take some actions. Whereas we look at tiny little industrial companies and healthcare companies who've said, you know what, we only have 20% women in leadership. Let's get it to 40, and we're going to do it in 2 years, and they do it. And that doesn't tell you that they're nice and fun and great people. That tells you their organization works. They can enact change. Their governance is functioning. They can set goals. That's a better long-term investment. And so I think part of the problem with ESG and the assumptions is we really simplify it down to, here's the important investment stuff, and here's a bunch of diversity and environmental stuff, which really doesn't matter because it's over here. When in fact, what we believe at our firm is the environmental and social data is fundamental company data. It should be in the financial statements of the company, and it's going to be in the financial statements of the company. And when you look at the data like that and use it to assess the quality of the company, not just some ESG checklist, then it starts to make more sense. And what's funny is there's very few investors doing that in the world on a professional level. And again, it's come because of the bias in the background. And what do you do with diversity data? What do you do? How do you fit changing diversity, woman, gender, or racial diversity year over year in portfolio construction? I mean, we use it because it's a sign of innovation and agility and quality governance. But most investment firms, most professional investors don't know enough about equity and inclusion until this year, although they're slowly learning to even begin to figure that out. Whereas I think a lot more of the general population actually gets it. So it's a lovely mess.
Yeah, no. And I mean, there's so much data out there that shows that the profitability of companies with more diverse boards, more diverse management teams, they just make more money. I think it's part of it's you just get rid of that group think thing. And then a lot of the stuff that you talked about, we did show a chart of the S&P 500 versus ESG investments, and ESG stocks are outperforming this year, 2020. They also, a lot of them did in 2019 as well, outperformed the S&P 500. You see ESG up 8.3% versus the S&P up 5.6%. So you kind of dug into it. There is a sector play when you think about ESG investings, and you talked about it in a lot of different ways. But one sector that you oftentimes see in a lot of these ETFs that focus on ESG is the tech sector. Do you think that makes sense? Because there's a lot of, you read in the headlines all the time, the diversity issues, all the different, privacy issues, things like that they have to deal with. What do you make of that makeup of ETFs that are tech heavy and tech or heavy in tech? How did that happen?
There's two reasons for it. One is traditional theory, again, where they got to hold all the big names and they can't deviate. We have the same problems in ESG strategy that exist in active or passive. A lot of folks hugging the index. But what happens in ESG is we tend to, at least the systematic and the passive ETFs, go off of ratings. And ratings have a lot of problems, and there's some use in ratings. But the problem with ratings is financials and tech, because they don't have chemicals or wastewater or any of that stuff, they just score higher, falsely higher. And so they end up in all these products. And there's some good tech companies out there, absolutely, but certainly not ones with huge privacy and data issues that they cover up for 18 months. Certainly not ones who settle sexual harassment suits for hundreds of millions of dollars after debating it at the board level for 2 years. Certainly not ones who underpay all their employees, which is a bunch of them. And so how do you, and that's one of the problems. I get this question all the time. Liz, this is an ESG, not ours, it's somebody else's ESG ETF, but it has Amazon, Facebook, P&G, Nestle, Bank of America, and a bunch of companies. And some companies are okay; they're trying their best, but other companies are like, they wouldn't pass a screen of really kind of most folks in the world who know anything about workers' rights or decent work or in the environment. And so, again, the products are being put together by teams that are not diverse, and they're manufacturing products, so they're comfortable throwing in all the regular tech because it's not that bad, right? You don't want Exxon in your top 10, I guess, although frankly some have it. But Facebook has a highish score, so it's okay. We're going to ignore a bunch of other stuff, and so it's the two-part. It's the traditional theory intersecting with folks not really knowing exactly what to do with the data, and of course any ranking system has problems. One of the things that happens, Sustainalytics switched their rating system, but if you're an industrial company with heavy, whether it's you're a paint manufacturer, or you're doing, natural supplements or whatever, because of your emissions and your water use and all that stuff, even if you are one of the best ESG companies on earth, you're gonna rate lower. With a bank and tech, they just don't have any of that. And so even if they have awful privacy and awful equity issues, they're still going to come about the same as those top ESG companies. And then of course the ESG rating systems are all over the place too. So, I think overweight tech is fine if you're doing it for the right reason. But at the same time, there's a lot of tech companies out there with high ESG scores that wouldn't make our cut. We look at things like board diversity. And one thing that's really interesting about ESG is almost all the data sets are gender diversity only. So if you want to look at racial equity and racial diversity, you got to do some of your own research, your own primary source research. So it's and the tech companies are awful. The tech companies are just, except for a few, are literally they've moved backwards. So you've got about 14% women in tech roles. Lower number in leadership, and that's down from about 20% a decade ago. So the tech guys, and what that says to us as investors is their culture isn't really long-term focused. If they spend all this money on equity and inclusion programs, but they can't move the needle on their actual worker profile and leader profile, especially those tech jobs, they don't really care. So you can really tell that pretty quickly if you go to their website or do some basic research on some of these companies.
Yeah, I think you make a good point there. When you think about the future of ESG investing or ESG in general, how do you see it changing over the next 5 years or so? Are the standards going to change? What's happening to drive the change of the future of ESG?
The good thing is the governments and their policies, even in the US, are what is driving the change. So, and I'll give you an example. In California, they have one of the most detailed reporting requirements for workforce composition. And so companies working in or headquartered in California, which frankly covers most of the US, have been doing for a couple of years a detailed racial and gender breakdown of their workforce by levels and reporting it. And so now what you see in sustainability reports are a copy of that grid for some of the companies. So we're getting a look into how they've changed their portion of Black leaders in the past 4 years, how the women have gone from 30% to 40% of the workforce because of targeted work by setting goals and achieving them. So that you can see that's going from policy to companies to then the investment decision maker, whether it's an individual or a firm like ours, can see more detailed data. At the same time, you have other investors pushing companies that are ignoring most of the stuff to change, right? And some of times they do that because they want to keep investing in a bad company, and other times they do it because they actually want to affect change. Where ESG is going is that data, so gender, racial diversity, pay, comp, parental leave. I was looking at a nice summary of parental leave by gender from a company in our consideration set yesterday, where men were taking 40% of the parental leaves, which is amazing. So we're going to be reporting that detail. And some people see it as soft, gushy, feely data. We see it as fundamental company data. It's their workforce composition. Same thing with the emissions and water use and fuel use and miles driven and airplane. That's company data. It costs them money, right? To fly everywhere. For them cutting down their business travel by 20%, saves the money, makes their employees happier. It's a smart business decision. So what's going to happen is the useful, because a lot of ESG data is not useful, but the useful data is going to move into the company's financial statements. It's going to become audited annual financials, probably not quarterly anytime soon. And so instead of having two different reports, because a lot of companies now, they have an annual report and they have a sustainability report. What's happened is the smart companies combine them. So now you've got a handful of companies, lots in Europe, but a handful in the US, reporting their workforce data and their environmental data along with their financials. And so the companies are doing it. The investment industry still separates the two sets of data like they're completely unrelated. But the policy is driving the companies are driving the change, which is their customers and their employees, and occasionally the investor trying to get them to change. But they know they're doing it because it's good for the bottom line, not because they have to, because paying fines and all this stuff costs a lot of money. So the change is, I would have thought before I got into this role that more change was going to come from the investment managers or whatever, but we're a really bad industry for even understanding equity and inclusion. Whereas the corporations we invest in, and all of us, are looking at supplier diversity policies if they don't already have a supplier diversity policy. Right? We haven't, in the investment world, we're still only beginning to talk about, should we have diverse, should a pension have a diverse manager like Honeytree that's a woman manager, or is it okay that all of our fees are going to men? So the drive will not come from the investment industry. We'll keep on coming up with weird products that aren't quite ESG. The drive is going to come from policies, and some of you will be familiar with the Department of Justice tried to say this year ESG shouldn't go in retirement plans, and there's a bunch of background on that. But they in Europe, it's kind of the whole thing's being mandated. So it's a fascinating mess, but it's really the companies and the governments, the investments just on the side.
Yeah, I think, the great thing and the reason corporations are focusing on it is because they know that if you're focusing on some of these ESG issues, it gives you a longer term focus. So you're more able to handle some of the challenges, whether it's climate change or diversity or whatever it is, a lot better when those issues arise, because you've already thought of it. Or if it's something else, that might be more catastrophic, or maybe it's the pandemic, or it's maybe social unrest like we saw earlier this year. So I think corporations are already thinking about it. It's almost like what you're doing makes a lot of sense. You're looking at the company that are on the forefront of making these changes, that aren't waiting for the policy to come across. which obviously there's a lot of different state, local, as well as federal legislation that's in the works to focus more on this type of stuff. So that'll be interesting to see it unfold. But we only have about less than 10 minutes left here. So I want to get some of the questions from the audience for you here. Let's see, we've got a lot. What are some companies that focus on ESG? Give some examples for these people. Any off the top of your head that like are
Trying to think of what's the best example.
I would say I'm biased, but I think Ally is a pretty good example. We have a great employee program and focus.
Ally is a great example. There are very few financial firms, and what happens in finance is the bank side might be a little more like Ally, but the investment side isn't like Ally. They've got 10% women portfolio managers. I'll talk about Bank of America because it's not in our portfolio. Bank of America has done a very good job of racial diversity and gender diversity on their bank side. They're close to 50%. What the pay levels are for all the different folks is we don't have those details yet, but they have specifically gone on and done a lot of work in the last 5 to 10 years. And they kind of coined the word responsible growth. We kind of took that from them. But then the problem, and this is true of every company. So the best companies in the world have tons of problems, just to be clear. So then Bank of America, you go to the brokerage, the capital market side, and they have makeup and hair policies for women in client-facing roles. So, how do you match up, right? And this is true of any company, even all the ones we hold. How do you match up the change that they are enacting, the employee-centered work that they're doing with the other part of the bank that's not doing it? Clorox, which I'll bring up, Clorox, honestly, I would have thought 10 years ago it was like an evil plastic company with chemicals. I've been pretty anti-chemical and world destroying since I was young. And but they have one of the biggest roles in the world in changing how we package cleaning products and what chemicals go into those cleaning products. And so if you take a quick look at Clorox, you will see sustainability and long-term focus baked into their process. Now, they're not, the coolest company in the world, although they've done quite well this year. But it's really balancing. It's really saying, okay, we have this financial data, which is great, but what additional data can we use to assess this company and dig into it a little more on how they're operating? And one of the highest rated companies in the world is this tiny little European company called C.H.R. Hansen. And it basically, it's making products out of algae. It's making food additives out of algae. It's, it's already completely renewable energy. It's their entire purpose is sustainability. Most of the European companies have issues with racial equity, but that's a story for another day. I think there's a lot more companies who are there's a lot more companies who are doing it right than we think. That being said, there's not that many. In whether it's and there's a lot of companies who are really good at the environment and really crappy at everything else. And there's some companies who are really good at employee donations and engagement and training, but they haven't done that much work on equity and inclusion as evidenced by their progress. And they've got some big chemical issues over here or legal issues, right? And, pharma companies, one of the problems, we talked about the tech being prevalent in ESG strategies. So are pharma companies. And pharma companies, like their product is like saving people, right? They're even considered more impact than most sectors. But find me a pharma company that hasn't been in a price fixing scandal in the last 2 years. And so it's really the balancing everything is very tricky. And so the answer is even the best companies in the world have a lot of problems.
Yeah, sometimes it's easier to eliminate companies like that from your investing strategy, which is the way I think ESG really started a really long time ago. But like I always think of like a Patagonia comes to mind,
They're
Nike.
Patagonia is the model
They are.
of purpose-driven organizations. If I could invest in Patagonia, I would. We like to
Yeah.
model our corporate culture after them. But yeah, it's Patagonia is the best in class for sure.
Or we got another question for you. How do you stress test the moral aptitude of the companies that are part of an ESG fund? I don't know if you have a thought on that.
Yeah, I mean, I think every company has moral issues. And what you want to see is when they mess up, what do they do? And so covering stuff up for 18 months is the wrong answer. um, Being honest about the mistake and fixing it, I think that's what we look for in our investment process when things come up, whether it's something in the past or a current issue. How do they deal with it? You know, we've had some companies in the portfolio have equity and inclusion issues. How do they deal with it? No company's perfect. Like there's no company that's perfect on equity and inclusion. And so they're all, especially in the large corporations, how are they dealing with issues? How are they addressing issues? If they're just writing a policy and doing a press release and they don't really care, it's what actions are they taking to make themselves better, and what actions are they taking when things go wrong, because they're going to. So that's how we measure, the overall morality. And the morality is important as an investment decision. You don't want a bunch of folks lying and making stuff up on a board or a management team some people want that on the companies they invest in. We don't want that in the companies we invest in. We want them to do what they say they're going to do. We want to trust them. We want them to be good, upstanding citizens and corporate citizens. So there's so many different ways using ESG, and folks do it using financial stuff too. But if Facebook says they're committed to equity and inclusion, but you look at their 5-year performance and it's still the same gender or woman in leadership percentages 5 years ago, I don't know, that's a moral ding, negative from my end. So the data the ESG, the environmental and social data and governance allows you to kind of look at that side of the business. In even though we call it morality, I think it's just about a quality business or not. Morals are part of operating.
Definitely. Well, Liz, that's unfortunately all the time we have today. It flew by. We learned a lot from you. It was really great having you be part of the program today. I know our viewers appreciated you. But before I let you go, just really quickly, how can our viewers get in touch with you or learn more about what you do?
I rant most about ESG on Twitter. So I'd recommend starting there at Liz Simmie, SIMMIE, all one word. You can check out honeytreeinvest.com, see our modern website for an investment firm. One day we'll be in the US as a product, so look forward to serving some of you then. But it's been wonderful, and I'm glad to help out on my favorite topic.
All right. Well, that's going to do it.